Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, January 22nd. And I don't think anybody would be surprised, say that, we actually have had inflows. I mean, the reason we would have inflows, obviously, year-end funding of IRAs and 401ks and the like. But I think what you might be amazed at is that even though we had, I'd say, mixed economic news and certainly disappointing earnings in some cases from some big names, we actually saw about $18.8 billion of net new money come into the conventional fund business. And again, this is despite having kind of on and off news of the economy's off, the economy's on, and also the earnings reports have been fairly good, from Netflix doing just fantastically to some of the banking firms actually doing very poorly. So, but let's show you how the flows actually panned out into our macro groups. We can tell you that for the month or for the weekend, Wednesday, January 22nd, equity funds saw about $4 billion in net new money coming into their coffers. Taxable bond funds saw $2.4 billion come into theirs. Muni bond funds for the second consecutive week saw an inflow a little bit under $100 million. And then money market funds saw about $12.3 billion. Actually, we can go back almost 36, 37 weeks where we did not have all four macro groups firing on all cylinders at one time. So this is really actually a special week considering what was going on. Well, why don't we go ahead and take a deeper dive and take a look at what happened in equities in particular so we can start seeing where the money actually flew. We saw about returns for equity funds of about 0.19%. Nothing to write home about. The second consecutive week of plus side returns. And we saw about $4 billion net new money, fifth consecutive week of money coming into this group. When we take a look at the breakout of domestic versus non-domestic, we saw about $2 billion going into domestic and about $2 billion going into non-domestic. So no big story there. But I think what the big story was is that it was the sixth consecutive week we saw it going into non-domestic funds, and certainly that's the story to write about. But when we talk about the large cap group taking in money, it was people kind of looking for safety of a sort. And so we saw about $1.3 billion going into this kind of safer region of large cap funds. And another vote for safety, as we saw on the international side, international equity funds taking about $1.7 billion, and certainly a big chunk of that was just to our global and I should say international developed market types of funds. So international multi-cap core and growth and value, those type of funds took in the money, and only about $200 million of that was emerging markets. So if we're taking a look at the international markets, so what we can say is people are shying away from China region, India, Latin American funds, emerging market funds, and actually trying to put it into developed markets. So we're seeing a little bit more in European funds, a little bit more in Japanese funds, and certainly in this broad grouping of international multi-cap, international large cap, etc. So that was where the story is. Well, we had a little bit of tales of two cities again for ETFs. Let's go ahead and take a look at our ETF numbers and see that we had about, it was actually a little bit under $300 million in outflows. But how it broke out is that we saw people actually go after small caps this week, a little bit of front running maybe. iShare Russell 2000 took in about $1.5 billion. The financial select services sector Spider Fund actually saw about $400 million in net new money coming to theirs. But where we saw money actually just leap out of there was from what has been up and running, and it has been doing very well and hitting records for a whole year. I think people basically saw some overbought signals going on. So they pulled money, particularly the authorized participants, out of the SPY or the Spider SP 500. This saw about $3 billion in net new money, or money actually exit their coffers. Now we take a look at the QQQ, the PowerShare QQQ. We also saw outflows. Despite it having the only weekly return from Wednesday to Wednesday, it had about a 0.61% return if you take a look at the NASDAQ, but we still saw about $1.6 billion in outflow, and certainly that was in anticipation probably of what we've seen here recently. Yesterday, Thursday, and Friday today, we've seen huge outflows, and we've seen a lot of money leaving the markets as far as negative returns. I think we're down about 200 on the Dow this afternoon, on Friday afternoon. So certainly we've seen some really disappointing things. It's gone down below 16,000, and certainly it looks like it's going to keep on running for that as well. Well, let's see what happened to the fixed income universe, because there's a flip side as well. We've actually seen net inflows into fixed income funds for the third consecutive week. $2.4 billion this week, a nice chunk, to the week before, and something like $4 billion the week before that. So people are certainly coming back into fixed income funds. Seventh consecutive week that we've seen plus side returns, only about 0.08%, but certainly plus side. Where the money went was we saw the corporate investment grade debt funds taking about $1.6 billion, and loan participation funds were about $730 million of that sum. And they have seen inflows for 84 consecutive weeks now. So certainly people are anticipating a rise in interest rates, and these are those adjustable rate type of securities, loan pars. Now, if we also take a look at the government funds, government mortgage funds actually saw outflows. So we saw about $200 million out of that, even though we saw a drop in yields. So we've seen the yields going from about 3.01 in the beginning of, maybe even as high as about 3.04 at the beginning of January, to about 2.87 right now. So we've seen actually a big chunk of yield getting dropped off. People are still concerned, obviously, and that's on the 10-year, by the way. People are still concerned, though, that the Fed is going to have some interest rate increases. So certainly that's how we got some big movements in the ETF universe. Let's take a look at our ETF group and see how they took in money. About $681 million of net new money came into that group, and this is the second week in 3 that we've actually seen plus side flows into that group. And at the top, this is where it's kind of mind-numbing. The iShares 20 plus Treasury bond actually took in the most, $280 million. Not a lot to write home, but this could be a twofold. First of all, they were just making bets that the yields were going to drop, which they did, or people are buying inventory so people can short. Who knows what it actually is going to be? Short-term weekly flows, you can't really determine trends until you start seeing a trend established. But on the flip side, if we take a look at iShares Treasuries, short-term Treasuries, they saw $130 million in outflow. So people have been playing the short end of the curve. Now we're seeing outflows out of the short end of the curve. So certainly short-term and mortgage-backed securities have been the pariah of late, and just in the last week or so, and that's kind of a new thing for the short term. Certainly the mortgage backs make sense with the Fed actually coming out and talking about doing some easing in actually taking away easy money in January, and of course we have the Fed meeting in the next week or so, and talking about what they're going to do for February. So certainly a lot of people are concerned about that. Well, let's see what's happened on the muni side. Muni bond funds saw an inflow of about $60 million. Not a lot to write home on, but it's the second consecutive week that we've actually seen inflows. This is in 36-week period. So we've seen 2 consecutive set of inflows in a 36-week period. So certainly things are starting to move in that area. It's the 4th consecutive week we've seen plus side returns. This time it's 0.37%. And a lot of people have been taking a look at the yields against their Treasury counterparts, and they are very attractive. So certainly we may see some more buying. National munis took in about $144 million net new money. Obviously, if there's 60 positive, that meant single states actually handed a big chunk of cash back as well. So we have kind of different modes going on as far as when we're taking a look at muni bond funds, but certainly something to keep an eye on. Let's turn our attention to money market funds. Money market funds for this first week in 3 saw inflows, $12.3 billion. A nice chunk came in. Certainly this can be really a signal that people were trying to put money back to work. People that were doing investment in 401k and IRAs and trying to get money in before the tax deadline in April certainly may have done it, but were not convinced that they wanted to go into equities or into fixed income. So we see a big chunk of about $12.3 billion. How this broke out, taxable money market funds saw about $12.6 billion net new money coming into their coffers, and how it broke out. Institutional funds put in $15.8 billion. Now institutional funds can be made up of institutional investors, but they also can be made up of our 401k plans that we have in all the organizations around. And so that was 15.8, and we saw retail investors actually hand back about $3.2 billion in money markets, so they took that out of the coffers. And then when we take a look at the tax-exempt money market funds, we saw just a small outflow of about $300 million. Certainly, as we go forward, we'll keep watching those type of trends where people are parking their money in money markets as we are approaching really some turbulent times. And here's where it is. As we get going over the next several weeks, we're going to keep an eye on 3 major things. First of all, we're looking at right now the market sliding. Like I said, Thursday and Friday we've seen some of the biggest declines that we've seen since 2012. That's really big for one-day declines. I think we're plus 200 points down. The day before we had triple-digit declines as well, so certainly people are concerned about that. A lot of people, including myself, have expected this. We have a little bit of a meltdown going on, and certainly a little market correction of maybe 5 to 10% certainly is order after having 5 consecutive up years, very strong markets. Having a little bit of a meltdown certainly is going to be bad. We'll have to see where this stops. People are concerned about what the Fed is going to do in their next Fed statement. Next meeting minutes will certainly be of interest to people. And certainly as we take a look at China's situation, China is actually talking about slowing growth. In the past, this has been considered one of the big global growth engines, and now from economic news out of China, it certainly looks like they're slowing down. And last, we've seen some, I'm going to call it so-so earning reports coming out. Like I said, we've had some big misses, but we've also had some big numbers come in, again, such as Netflix and a few other groups as well. So people are going to keep an eye on those type of events as well. Well, if you want to do a deeper dive, you can certainly go to our website, that's lipperusfundflows.com. Click on the areas that you want to take a deeper dive in. If not, you can join us next week where one of our analysts will tell you a little bit more about what's happening for the week. Well, my name is Tom Rosine. I thank you for joining us today, and I wish you the best in your wealth planning and creation.